Oh, hey everyone, this is Dale Anderson from Fabric Invest. Hope you're well. Just wanted to run through the latest Savills residential reports. I know we went through Zoopla recently, just showing how house prices have been on the increase. Despite at the beginning of the pandemic, there was a lot of fear mongering and people expected prices to drop. In fact, the Bank of England was forecasting a dip. Anyway, so just to back that up, we've got the latest Savills residential report as of the end of July, and they were just showing that the average UK house price has continued to rise strongly. In fact, UK mainstream house price growth is forecast at plus 9% in 2021. So again, more growth to come in 2021, but we do expect a bit of a softer landing in 2022, albeit still projections that prices will continue to rise. So a lot of this has been the imbalance. Obviously, it looks set to maintain growth for the second half of the year, meaning annual house price growth across the UK is a staggering 9% this year. So definitely investors buying at the beginning of the year in certain locations, of course, can expect some healthy increases. We expect transition levels to diminish gradually over the remainder of this year. The government support for both the housing market and the wider economy, is withdrawn. There may be a case where interest rates will rise. I don't expect interest rates to rise for a while because naturally they need the economy to keep going. But there is evidence that capacity for growth post 2021 may slow down slightly, albeit steadily. Again, this is just due to the imbalance of demand. So if we look at the chart here, we've got UK house price growth, 5-year total projection at 21%, this year 9%, and then they reckon that should go down to about 3.5% next year as an average. London a bit slower than other regions across the UK, as we mentioned last week. People in the northwest, for example, in Liverpool and Manchester, topping the charts for growth over the next 5 years. So a softer landing. There's 5 factors to consider here. Number one, the pace of the economy recovery means unemployment levels have been contained and are forecast to progressively return to pre-pandemic levels. So we should see an economic boost. Price growth seen since the housing market reopened last year is partly driven by the change in buyer profile and demographics. A lot of people realizing, well, maybe offices don't need to be based in London, or do we even need an office? Our staff are working very, very well from home, or more flexible solutions where they may be going into the office only a few days a week. So a lot of people also been driven out of London because of the prices. I mean, it's just anyone between the age of now sort of 25 up to 40, it does become on the average wage extremely difficult to get on the housing ladder. So people are being driven to commute belt regions, and they're also being driven up north. There's a huge north-south divide when it comes to pricing. So again, people looking maybe for a bit more space and less reliance on mortgage debt, lower interest rates, of course. Number 3, this is combined with more activity from higher earners. The average loan to income ratio has not moved dramatically. Buyers active in the market have been able to operate within the bounds of existing mortgage regulation, which has been a lot more affordable. Number 4, more of those buyers have been able to lock into low-cost fixed-rate mortgages for longer periods. So if you are looking to take out a mortgage, whether you're a first-time buyer or a homeowner, now's a great time to get a fixed rate because you're never going to see rates like this as low as we've seen recently. In fact, since the recession of 2008, they've been kept pretty low, to be fair, because we then had Brexit, we now have the pandemic, so they haven't really had a choice but to keep borrowing rates quite low. Interest rates, number 5, interest rates rises are still expected to be gradual and modest. So I expect it's not going to be an overnight decision where they say, oh, we're just going to increase or double the rates, or that's going to cause chaos in the market. So we expect it will be a gradual increase over the next 3, 4, 5-year period as the economy recovers and as things hopefully get back to some normality. So what does this mean? We don't expect a trigger for major house price correction just yet. In my mind, we're probably looking the next 4 or 5 years of solid economic growth and gradual price increase growth. This pattern, can't carry on forever. There will be a point where interest rates will go up and there will be some sort of a correction, or the market becomes overheated. But, we expect that to be not in the immediate future, at least between 2022 and 2025, where markets may normalize. So yeah, by no means is there any sort of certainty on this, but Savills to date have been fairly accurate on their projections. In the last sort of 15 years I've worked in the industry, I have found them a very reliable source when it comes to house price movements and rental market updates. So on the mainstream media, if you look at the chart here, the Northwest is leading the way at 28% over the next 5 years. That's 10.5. I mean, last year they only expected prices to go up about, a year ago, they were saying about 4 or 5% in the Northwest. It's gone up 10.5. So, anyone who bought with us just over a year ago, the prices have certainly gone up. So 28% growth over 5 years. Yorkshire coming in at second place, 28%, so matching that of the Northwest. Wales as well, quite interesting, 26%. Scotland at 24%, Northeast 23%. So what you can see is a huge divide between London and then the southeast and southwest of England, and then the northeast, Wales, Scotland, and northwest leading the way for price growth. So again, these are areas we focused on for the past few years. Places such as Preston, Liverpool, Manchester, Leeds, these kinds of areas, still good value for money. You're getting better rental yields. So some really good opportunities there for your buy-to-let investors. Risk still remains, of course. Path of interest rates remain crucial to our house price growth forecast. Steeper than anticipated jump in rates would certainly restrict growth, but it would have to be quite severe to lead in any actual value falls in value, because we've seen them bouncing anywhere from 0.5 all the way up to sort of 2-3%, and there's still been steady house price growth. So regional views, we continue to expect the markets of the Midlands and the Northwest of England to grow rapidly. Rates of average regional to average UK house price growth, as you can see on the charts. You've got the Midlands, you've got the Northeast with the purple line there, the Southeast there with the black line, East of England, Northwest and Yorkshire, Southwest, London, Scotland and Wales. So again, if we look at places like the Northwest, rates of average regional to average UK house price growth has been quite considerable over the years. But this chart goes all the way back to 1974. So as you can see, London has certainly led the way, but now we're starting to see a slight dip in the London prices. And this chart here at the bottom, where the Northwest got quite affected by the recession and the pandemic, we're now starting to see the prices rise again. So interesting there. London, a market divided between flats and houses. It's performed better than we actually expected, but I think people are being driven out into areas like Kent or southwest, or places where they can get more value for money, or buy a family house, or instead of living in a small apartment closer into London. So yeah, that's definitely affecting the movements in the market there. Also, implications for first-time buyers. Since the inception of the pandemic, we've seen a market increasingly weighted to equity-rich home movers. First-time buyers have struggled over the past year, with younger people obviously facing higher rates of unemployment and furlough. So unfortunately, it has become more challenging for first-time buyers. Demand's certainly dropped on that front, but I do believe first-time buyer market activity will increase, specifically in areas perhaps outside of London, where they may now reconsider moving to live, just for better value for money and more affordability. So that's where I see the first-time buyer market heading. Looking further ahead, you've had the mortgage guarantee scheme. That should boost a lot of demand from first-time buyers, and the end of the stamp duty holiday, obviously that's had a slight effect as well. Looking further ahead, to the end of the Help to Buy scheme in 2023 will knock back first-time buyer numbers, albeit still strong activity in the market there. We call it generation rent. A lot of people unfortunately are having to rent unless they've got the bank of mum or dad or unless they, are fortunate to be in a position of earning a certain salary to be able to get on the property ladder, especially in the case of London. So yeah, that's what we're looking at. Yeah, first-time buyers fall behind home movers, and you've got your list of your first-time buyers there on that graph. Your number of first-time buyers highlighted there, and then your number of home movers. So some very interesting stats there over the last year, and you can see the different levels of mortgages and mortgage activity over that period. So yeah, I hope that really helps. We'll keep you posted on the latest property market news, and yeah, all the best. Any questions, give us a call or one of our consultants anytime, and we'll be more than happy to assist and share this valuable information. Take care.